Rough week for the banking industry.
The collapse of Silicon Valley Bank.
I'm quite sure that some of you might have forgotten what caused the 2008 financial crisis, and are also curious to know why the Silicon Valley Bank collapsed. Let me tell you that this is the biggest US bank failure since the 2008 financial crisis.
The second biggest bank collapse in US history.
And I'll be sharing how this crisis will affect you and what lessons we can all learn from it. In this video, I'm going to dive deep into the collapse of Silicon Valley Bank and explore 5 stock investment strategies you would need to follow when trying to identify a good company or its stock to purchase.
Here, first of all, what is SVB? It is the epicenter of tech startups, venture capital, Silicon Valley Bank. It is the 16th largest bank, or it was, in the United States.
But before we get into the strategies, let's first look into the story of Silicon Valley's bank downfall and what we can learn from it. So what caused the Silicon Valley Bank collapse? You see, the failure was caused by a run on the bank. The company was not insolvent.
That the American banking system is really safe and well capitalized.
But banking relies as much on confidence as on cash. So basically, if that confidence runs out, the game is over. I believe the collapse may have been an unforced, self-inflicted error, and I'll tell you why. You see, the bank's management chose to sell $21 billion of bonds at a $1.8 billion loss. This was in large part because many of those bonds were yielding an average of only 1.79% at a time when interest rates had risen drastically and the bank was starting to look like an underperformer relative to its peers. So guys, let's dive into 5 stock investment strategies that you can use to identify what companies are best performing and that you can invest into. Let's go! Number 1. Look at the company's financials. Guys, the first strategy is to look at the company's financials. There are certain key financial ratio indicators that you can look into. One of the most important things to consider when investing in stocks is the financial health of the company you're about investing into. It's important to analyze the company's income statement, balance sheet, and cash flow statement to understand its financial position. This is going to give you a clear idea of how the company is performing, and it would help you identify any red flags or warning signs. For example, in the case of Silicon Valley Bank, one red flag was the bank's decision to sell $21 billion of bonds at a $1.8 billion loss. That's outrageous, given the economic climate that we're in right now. You see guys, this decision was made because many of those bonds were yielding an average of only 1.79% at a time when interest rates had risen drastically. This was a clear sign that the bank was underperforming compared to its peers, and it should have been a warning sign for investors. Number 2. Paying attention to industry trends. Guys, the second strategy is to actually pay attention to industry trends. Now, how do you go about doing this? Another important factor is to consider the industry trends of a stock or a company that you want to purchase. It's important to stay up to date of the latest developments and trends in industry in which the company operates. Basically, this will help you understand the company's competitive position and identify potential risks and opportunities. For example, in the case of Silicon Valley Bank, the company invested its deposits in low-interest rate bonds that it held on its books on a long-term hold-to-maturity basis. Basically, this left investors with a somewhat distorted view of its balance sheet. In a nutshell guys, this was a risky strategy, especially given the rising interest rates at the time. I wonder what would have happened if the bank had just paid more attention to industry trends and adjusted its strategy accordingly. It may have been able to avoid this collapse. Number 3. Look at the management team. Guys, before investing in any company, you have to always look at the management team of a company, because failure to do so will have a big impact on your financial returns. It's important to analyze the experience and track record of a management team when considering investing in any stock or company. For example, in the case of Silicon Valley Bank, the management team made a number of critical errors that led to the collapse of the bank. They chose to sell $21 billion worth of bonds at a loss, which was a clear sign of an underperformance by the bank. They also made a tactical mistake by selling convertible preferred stock, which couldn't be sold until the next day. So what does that mean? These decisions that they took led to the exodus of deposits and the collapse of the bank. So guys, by looking at the company's management team, its products, and its industry, you'll be able to see if it has a long-term growth potential. Let's look at how to identify a company with good management. In 1997, Amazon went public at an initial public offering, which is called an IPO, of $18 per share. By the end of the day, the stock had soared to about $24 per share. At that time, many investors thought Jeff Bezos' Amazon was overvalued. But those who did their research saw the company's potential and invested into it. Fast forward to today, Amazon stock trades at over $3,000 per share. By the way guys, if you enjoyed this video so far, I'd love it if you could give me a thumbs up, as it would help the YouTube algorithm share my video to many people like yourselves. Alright, now let's move on to the next investment strategy, where I'll share more insights that you can use to identify the right stocks or companies to purchase. Number 4. Consider the company's competitive advantage. A company's competitive advantage is another important factor to consider when investing in stocks. You see, it's important to analyze a company's business model and understand how it differentiates itself from its competitors. For example, in the case of Silicon Valley Bank, the bank had a unique client base of venture capitalists. On one hand, this was a competitive advantage that set it apart from other banks. However, the bank failed to leverage its advantage and communicate effectively with its clients, which ultimately led to its collapse. What this illustrates is that by you investing in companies that have solid financials, a competitive advantage, and a strong management team, you can easily identify the best stocks to invest in and become wealthy. Now, let's look at an example of a company that had a huge competitive advantage, and this is no other than Google. You see guys, in the early years of Google, it had become a huge player in the search engine ecosystem, and this was because they had a strong management team and a competitive advantage in the search engine market. Google also had solid financials with a healthy balance sheet and consistent revenue. Today, Google's parent company, Alphabet, is one of the most valuable companies in the world. Number 5. Look at the company's valuation metrics. Guys, the fifth and final investment strategy is to look at the company's valuation metrics. It's very important to analyze the valuation metrics of a company when considering investing in its stock, and I'm going to share with you how to identify that. Basically, this will help you understand whether the stock is overvalued or undervalued. For example, in the case of Silicon Valley Bank, the bank's management chose to sell $21 billion of bonds at a loss because many of those bonds were yielding an average of only 1.79%. This was a clear sign that the bank was overvalued and underperforming compared to its peers. And there you have it guys. This was a quick review of what caused the collapse of Silicon Valley Bank, which was mostly caused by a loss of confidence in the bank's management. The collapse of the Silicon Valley Bank provides important lessons for you and I and investors alike. It's important to remember to follow the 5 stock investment strategies mentioned earlier, starting with analyzing a company's financials, paying attention to its management decisions, and keeping a close eye on market trends. You can identify good stocks and make the smart investments that will help you achieve your financial goals and dreams. That being said guys, it's also very important that you diversify your portfolio. My own take on this is that I believe we're nowhere done from hearing what really happened in the company leading to its demise.
On Twitter, he says, if the panic bank run.
Already, according to CNBC, the news flying around was that the Silicon Valley Bank employees received their annual bonuses just this past Friday, which was few hours before the regulators seized the failing bank. I think that's sketchy, but in order to prevent a systematic economic meltdown,
every American should feel confident that their deposits will be there if and when they need them.
The US government has now stepped in to bail out the bank. I'm quite sure guys, as the days and weeks go by, more details will be disclosed about other issues within the company. If you want a deep dive into how to identify what stocks to buy, especially with dividend stocks, then I encourage you to watch this video I made about it. Alright guys, I hope you found this video helpful and informative. If you've enjoyed this video so far, make sure to smash the like button and don't forget to subscribe to my channel. And while you're at it, kindly share this video. Also, click the notification bell to get notified each time I upload a new video. Until next time guys, always stay money smart. I'll see you guys in the next video. Bye.